Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. This week we'll focus on our key market indicators, as well as continue our discussion by reviewing the contributors and detractors of the market. Now we'll do this all while looking at both the equity and bond markets to provide a more comprehensive view of market performance and the impact to your portfolio. Now, additionally, I'd like to highlight a webinar that John Mark and I will be hosting on June 30th. If you enjoy these videos and are looking forward to a further deep dive on the market drivers for this year, please make sure to join that webinar by clicking on our webinars link on our website in the description below. So with that, let's hop right in. Now, onto the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 2.9% growth as of June 27th, which is lower than our previous week's growth report of 3.4%. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data fell by 9,000 claims, ending at 236,000, while continuing claims rose to 1.974 million. As mentioned last week, we'll watch the initial claims data very closely and track the trends as we move forward. This value, once it hits 250,000 and remains at around 250,000, has a significant association with the economy and markets as a whole. We'll also be looking at initial claims, while looking at initial claims, we also like to highlight those that are staying on unemployment insurance as well. As we've seen this, since the end of May, this value has continued to rise. So ending last week at the highest level we've seen year to date. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement in both the 30-year and 15-year mortgage rates, ending at 6.77% and 5.89%, respectively. Next, we'll look at investor sentiment. One measure of investor sentiment is the bull-to-bear spread. The latest update shows the bull-to-bear spread fell from 3.1% last week to a negative 8.2% this week. Investors are starting to feel bearish with the current market conditions. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price to action relationship to the S&P 500. Remember, the VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 are generally correspond to stable market periods. So this week, the VIX ended at 16.32. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating an 18.6% probability of a 0.25% decrease and an 81.4% probability of no decrease in July. With the most recent data taken into account, the probability for a July cut has increased by 9% since last week based on this data. And finally, let's take a look at how the markets ended. Last week, the S&P 500 was our proxy for growth and income, but only when considered together, ended positive 2.47%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, was positive 1.88%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was positive 3.38%. And the winner this week goes to international stocks. Another reminder about the importance of diversification. So remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. And if you'd like an unbiased review of your portfolio, don't hesitate to connect with any one of our advisors today. So with that, let's jump right into our discussion around the contributors and detractors that move these market indices in the past week. The equity market saw strong weekly gains last week, where the S&P 500 ended positive 2.5%, the Dow Jones Industrial Average was positive 2.8% for the week. The NASDAQ was up 3.7%, and the Russell 2000 was up approximately 3.7% for the week. On the other side of that, fixed income or the bond side, what we saw was that the 10-year yield slid by 9 basis points to end the week at around 4.3%. The 2-year yields also fell by 17 basis points following the dovish Fed guidance that came out. Now, after understanding what happened in the markets, what were the key factors that drove these markets? Well, we'll discuss that in the next section, really talking about the contributors and the detractors part of this discussion. So let's take a look at the contributors to the market performance. First, we'll focus on equities. Now, on the upside, what we saw, tech and AI continue to outperform. NVIDIA was up 9.7% for the week. Microsoft was up 3.9% for the week, and Amazon was up 6.5% for the week. And these were the major contributors as investors and enthusiasm around AI continue to persist. Earnings and macroeconomic data also supported the equities market, which included better than expected retail and durable good numbers. So durable good orders surged by 16.4% last week. We also saw consumer confidence come down a little bit. Now, ironically, this is actually an equity detractor, but a treasury contributor. Core PCE also came into play last week, and Core PCE, which actually defines personal consumption expenditures, and as we've talked about this in the past, is the Fed's preferred gauge on inflation, came in at 0.2% month over month, which translates to 2.7% year to date. Now, this highlighted sticky inflation, though the market didn't really react strongly negative to this data. We also saw geopolitical relief last week. The U.S. brokered a ceasefire between Israel and Iran and eased the risk sentiment. Now, on the bonds or fixed income side, what we found was the Fed staying put, and they held rates at 4.25 to 4.5%. This signaled patience, reinforcing the idea that cuts could potentially be on the horizon soon. Now, what we also saw on the Treasury side was that Treasury purchases for higher quality products improved, and we saw steady investments and demand for the municipal bond market. So now, after understanding what contributed to the market, let's take a look at what were the key detractors in the market. Looking at the detractors, two key factors impacted both equity and bond markets, though each had a differing impact on each market. Specifically on the equity side, what we found were large equity outflows continued. So when the market hits all-time highs or it gets near all-time highs, we tend to see slight pullbacks and sell-offs. Most of this is limited, and some investors are really looking to lock in gains. We saw the market movement with outflows of about $21 billion for the second straight week, and this is across all global indices. On the fixed income side, what we saw was the persistent policy uncertainty really come into play. And this is all around the U.S., really focusing on what's happening with U.S. tariffs and what we're seeing in terms of unconventional policy making. Now, this has dampened some investor confidence, which, as we talked about previously, has impact to the Treasury market. Inflation has remained sticky, as we talked about it previously, and there are certainly further concerns around the U.S. debt and deficits. Now, to summarize, what we saw was equities rallied into near record territory, which was buoyed by tech momentum and easing geopolitical uncertainty. But policy volatility and fund outflows suggest that there is underlying fragility. Bonds delivered modest gains, especially in high yield and municipal segments, thanks to the Fed's calm and safe haven flows. Both markets are navigating a landscape marked by strong fundamentals, yet offset by geopolitical fog and erratic U.S. policy makings. Now, in the week ahead, these are key things that I think are important to watch, and certainly we will be watching these as well. From a macro or data events perspective, looking at the June's jobs report, or the ADP report, which will be released on July 30th, ISM manufacturing, and which will be released on July 1st, and auto sales will also come into play on July 1st. These are all key data points that we'll certainly be watching. From the trade and tariffs perspective, understanding what's happening with the U.S. tariff pause, which expires on July 9th. Certainly market is awaiting decisions or extensions that come from there. The Fed's next move, obviously we are watching this very closely, but this week, Governor Waller, Vice Chair Bowman, and possibly Jerome Powell are speaking this week, which may provide additional commentary that could reshape the market rate expectations. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting the like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our our financial coaches or advisors, please click on the description below to schedule a meeting. Once again, thank you for watching. We look forward to seeing you next week.